Welcome to Wealth Builders. I'm your co-host, Tony Shore, and I'm here with our host. The man with the plan is Anthony Cangemi. Anthony, I am so excited about today's show. Here's why I'm pumped up. Because with all the craziness going on in the world today, I look forward to this show each week because you always try to stay positive. You're always about helping people, and the show is educational. And even when we talk about tough topics, it's always a good thing because I managed to learn something, and hopefully our listeners and viewers out there will as well. But Anthony, how have you been? It sounds like you're busy.
Yeah. Well, we have been, Tony, and thank you so much for that. I mean, the idea is for this show to be educational and to give real world advice for our listeners as it relates to retirement and retirement planning. Yeah. We want it to be, obviously we have just got, really, we've been so blessed with, our radio listeners and the folks that have just complimented us on the material. We really appreciate you guys out there. And Tony, frankly, I don't think we could do the show without you, man.
Thanks, Anthony. I appreciate you saying that. But you're the quarterback and the coach here for us, and the financial guru. So I've been good too. I celebrated my 60th birthday last week. Can you believe that?
No, wow, man. Yeah. You look great, man. The big 60, huh?
The big 60. Can you believe I'm already 60? A lot of people can't believe I'm 60. But I always say, I think it's my immaturity that throws people off. I like to joke.
Yeah, and don't ever lose that, Tony. And I know you won't.
Child at heart, right?
Yeah, that's it, but that's great, man. And so any revelation from, going into this next decade of being 60? I mean, have you felt any different?
No, not at all, actually. I mean, they say 60 is the new 40. I feel great. I think I don't feel any older. I always joke I don't feel a day over 59. But that's the thing. I mean, I think people are living longer and longer, which is good.
Yeah.
On one hand, but on the other hand, it's just that much more we're going to need, a longer retirement probably.
Sure.
I don't plan on retiring anytime soon, though. People ask, okay, now that you're 60, what are your thoughts on retirement? And I always laugh. I'm like, well, as long as my voice holds out. I work in radio. I do voiceover work. I've got the show with Anthony Cangemi. This is what I'm going to do for quite a while. So I plan on at least to my full retirement age, 67, if not longer. If I feel good and they'll have me and my voice is good, I'll be doing this show when I'm 70.
Yeah.
I mean, because when I'm 70, you'll just be 30, probably.
That's right.
35, right?
Yeah, 35, yeah, that's right. Well, Tony, with somebody like yourself, I mean, I always thought in dealing with our clients and retired clients and people, have been in these careers and their professions, all their lives. And then it almost seems, I don't know, just to shelf, if you will, all the experience, all of the wisdom that people in their various professions that people have had throughout their life, you think about all the wisdom and all the experience that people have accumulated, and then when you retire, it's almost like, well, you're just kind of putting all that on a shelf, and all that wisdom and experience just, kind of, I don't say goes by the wayside, but you're not able to share it.
It's somewhat wasted. Yeah.
And what I can say, for, just kind of as a general statement, that I find that a lot of our clients, or I see success, the clients that we have that seem to really adapt this idea, is to not necessarily, completely just shelf all that experience and wisdom. Maybe there's a way to give back in the community, or
Mm-hmm.
with people, younger folks that are coming through in that particular profession, and offer as a mentorship, and that sort of thing. So it really doesn't, have to be completely okay. I'm retired, and so all of the wisdom, all the experience, all of the knowledge that I've accumulated over the years, I mean, that's a wealth of experience that really should be shared, I think.
Yeah, I would agree, and you make a great point there. That's I've never really thought of it that way, but you're right. And hopefully, what I'll do is pass it along to I'm bringing up some younger people in our department. You know
Sure.
what I mean?
Yeah.
And they can learn from me, or maybe learn good things and bad things. Hey, I'm not going to make that mistake. So you can learn good
Right.
and bad, but if you do have this wealth of experience, it's good to pass it along. I mean, I've been married now for 33 years. I've been working in the radio and voiceover industry for 36 or 37 years now. It's a long
Yeah.
time.
It's a
Yeah.
long time and a lot of experience, a lot of wisdom, a lot of what to do and what not to do, as you
Yeah.
say.
Yeah.
And so, no, it's good, Tony. And, one day I would like to, do a show specifically on, at least what I've observed from our clients that are really enjoying their retirement, and really, seem to have just really a fulfilling and purposeful retirement, versus, clients we have and people that I've met over the years that are not enjoying their retirement like we thought they would. And years ago, in my earlier years, frankly, not that long ago, maybe 10 years, 5 to 10 years at the most, I used to always think, well, it's about the money. The people that have more money, or the people that have a better retirement plan, are going to have more fulfillment in retirement. And, frankly, that's just not true. Certainly a retirement plan and the things we talk about on Wealth Builders is important, obviously, but there really are some other aspects of a fulfilling retirement that do not have anything to
Right.
do with the money and the finances. And we should do a show on that, Tony, because
Yeah.
I do have some insights.
Yeah, and I think that would be a great show. Well, maybe we can put that one together for our next episode,
Yeah.
and continue that discussion. Today, we need to dig into what's going on with taxes. I know it's on people's minds, so kind of a taxation guide. And you guys have this great 2026 taxation guide, and it's new with great information,
Yep.
and you're offering that to our listeners today. So before we jump into that, you can get a complimentary, no charge, no obligation copy of this 2026 taxation guide. All you have to do is give the office a call, or visit the website, which is crescentcityretirement.com, to get a copy. And again, that's crescentcityretirement.com. And they can also call the office, and that office number, what's your office number there?
Sure. It's 504-828-2171, 504-828-2171. And it's a fabulous taxation guide on all of the different tax rates and contribution limits and all the things that are available for you in 2026.
Yeah, and I'm looking at the guide right now, and it has there's a lot of numbers, and you can find yours in there. Okay, here's where I'm at as
Right.
far as, here's what tax bracket I'm in.
Right.
Here's, standard deduction that I'm eligible for. It's great.
Hmm.
It's great to have these numbers and figure out where you're at,
Correct.
especially if you're headed into retirement or in retirement. So we're talking about this. What's the first thing you want to talk about? We're talking about taxes today.
Yeah, absolutely. And I would say, Tony, really, there's two aspects to our tax planning that we should consider. One would be the accumulation phase of our financial life, where we are working and we are saving and we are earning an income on the job. And what are the most tax efficient strategies that we can employ? What are the contribution limits? Should I be putting into a traditional IRA or 401k? Should I be putting into Roth 401ks, IRAs? Like, what is the tax strategy? What is our most efficiencies that we can employ in the accumulation phase before retirement, right? And then that next phase would be the distribution phase. Now we're retired and we're not putting money in anymore. We're taking money out.
Yeah.
And then how are we going to employ the most efficient strategies on that descend, if you will, or the distribution strategy? And so there's really two aspects of this. So in the accumulation phase, the question is, are we doing all we can do to offset our tax burdens as we are accumulating wealth? I.e., what are we putting into our retirement accounts, and what is our overall tax bracket? Where are we at? And does it make sense to be putting into accounts that can offset our tax liability now? Versus having to pay taxes on that money later, right?
Yep.
Versus putting money into accounts now that maybe don't give us the tax breaks now, but give us the tax breaks in the distribution strategy later, right?
Yeah.
So it really, we have to look at both sides of it. If you're just, trying to save all you can save in taxes now and maxing out the 401k or maxing out the SEP and really trying to drive down your tax liability now, but then it blows up on you later in the distribution plan, you want both sides of it. It's really, kind of the two sides of the same coin. We have the accumulation strategy, which certainly we want to be tax efficient, but then we need to be thinking about how that money is going to be coming out and what's going to be the tax strategy in the distribution side of it.
Yeah. Well, and I like how you're explaining that there is a mindset change that you have to kind of turn the way you think about things from the accumulation phase or your earning years while you're working, you're saving for retirement, and taking your income and saving, and then in your retirement years, you're doing the opposite. You're taking that savings and you have to turn it into an income.
Correct.
But I think the key piece people miss in that second stage are taxes, because they assume, oh, I'm not going to have to pay much taxes. I'm retired. I'm not working. I don't have that working income anymore. Sometimes some years you'll pull out more in retirement in a year out of those accounts and be taxed on more than a year maybe during your working years, right? That happens.
Yeah, absolutely, Tony. And, a lot of this kind of just sneaks up on people and sneaks up on you. And it's just simply because you've maybe never retired before, right? So, I mean, it's this whole distribution phase is something that you're embarking on. But, I'll give you a real quick, probably a pretty common, a common idea that, people will say, well, gee, I'm retired and but I don't need to pull any money out, or I don't need the distribution, or I can go without, or we can be a little more take less out along the way. And so it seems like that, is reasonable, right? If you don't need the money, why pull it out? All to just let a lot of this pre-tax money, 401ks, IRAs, pre-tax dollars, just accumulate, and accumulate, because, hey, we don't need to pull X dollars. We can take less. All all to accumulate to ultimately get to what's called required minimum distributions, or RMDs, where all of a sudden, if you're not careful, then your required distribution can just all of a sudden, blow up on you. And then now you're paying much higher taxes on that money because you weren't taking those distributions out strategically, managing those tax brackets along the way.
Yeah.
And so that distribution phase is every bit of as important, if not more important, than the accumulation phase. It's taking those distributions out strategically over time to where when it does default to required minimum distributions, it doesn't all blow up on you at that point.
Yeah. Yeah, I think that's really good to note. And so people really need to pay attention here and work with a trusted financial services professional who can work alongside CPAs. And you do future tax planning. I mean, a CPA is looking back at the last year or maybe at the best the current year, but you've got to be looking ahead. And there's a lot of changes to tax laws and the numbers, which is why people will find the taxation guide very helpful because it shows where everything's at and the current numbers. And I mean, they can really impact your retirement income and long-term financial strategy. So what I hear you saying here is you need a tax plan for retirement. And a lot of people don't understand that all their tax, or most of their retirement income, a lot of it will come from, some of it anyway will come from Social Security, but a lot of it's going to come from their retirement accounts, which are tax deferred, like a traditional 401k or 403b or traditional IRA. You have to pay full taxes. And even like you said, if you wanted to, even if you're like, well, I don't need that money in my IRA, eventually the IRS will make you start pulling a good percentage of it out and paying taxes on it. And all that money's taxable, isn't it?
Absolutely. In those pre-tax dollars, IRAs, 401ks. Now, of course, you have the Roth IRA and the Roth 401k, where those distributions are tax-free. You didn't get the deduction when you put it in, but now you're getting tax-free benefits when you take it out. And then you have after-tax money, Tony, this non-qualified assets, where the cost basis or the basis of that money has been taxed, but the dividends and the interest is also taxable, and you'll have short and long-term capital gains in those accounts. So the takeaway here, Tony, is that you have three different buckets of money that are all taxed differently. Okay.
Right.
You have your pre-tax dollars, which we just said is all coming out as ordinary income that's subject to required minimum distribution, like your IRAs and 401ks. Okay. Then you have your tax-free buckets of money, which are going to be your Roths, right? Roth IRAs, Roth 401ks, even some life insurance, cash value life insurance can be tax-free. And then you have your non-qualified assets that are also taxed differently. So when you're thinking about, and not for our listeners to say, oh my goodness, it's really, when you have the tax planning strategies in place, you can take those distributions from all three buckets of money based on how they're taxed to really have a very efficient, if you will, tax efficient is key here, distribution strategy. So it's not enough just to accumulate in the accumulation phase. We also need to be thinking about the distribution phase and where our money and income is going to be coming from when we retire, and what's going to be the most efficient way to take those distributions over our retirement. So it's two sides, Tony. It's the accumulation side, which needs to be considered, and the distribution side.
Yeah. Yeah. And so, and again, it comes down to those two sides, and you really need to understand them. And I think a lot of people have a pretty good handle on the accumulation side, to be honest. It's how do you make that transfer? How do you plan ahead for that distribution side. And how do you, and people don't take into consideration taxes because they think, oh, my tax burden is going to be much lower in retirement. Well, that's just not necessarily true. And they don't realize, Social Security can be considered taxable income, money you pull out of those tax deferred accounts, sometimes pensions. You're going to have things that are taxable in retirement. And, when you get to RMD age, which is now 73, required minimum distributions, we haven't talked about those. You have to take money out. You have to pay taxes on it. And that could bump you into a higher tax bracket.
Absolutely, Tony. You're so right. And, I've talked to many people in the past. Now a lot of these 401k plans are offering Roth 401k.
Yeah, most employers are now.
Yeah. All right. Yeah. And so a lot of our listeners may be, listening to us right now and saying, yeah, that's right. My 401k, I got something in the mail, or I heard that we now have this option. Okay. And so what I've noticed though, with the people that I've spoken to that have told me, oh yeah, my 401k, people that might have come in, say, yeah, our 401k now offers a Roth option. So I just switched. Instead of putting money into my 401k or my traditional 401k, now I switched all my contributions to my Roth. And, and so here's the thing, even though that on the surface sounds like, okay, that's a good idea. Start putting into the Roth. It'll be tax-free later. I mean, is that the best strategy? I mean, you just put it all into the Roth 401k and not take any deduction on the front end in the accumulation side. And so that's why I say, Tony, maybe half should go in the Roth 401k and the other half, right? But you wouldn't really know unless you did a tax analysis on the accumulation strategy so you can be as efficient as you can be now, but also consider the distribution strategy. And so there is an answer, certainly, to how much and what percentage you should be putting into your Roth 401k versus your traditional. Certainly there's an answer. But if you don't look at the whole picture, the accumulation on this side of it and the distribution on the other side of it, you're just shooting in the dark. I mean, you're just throwing darts at a wall. You're not strategically making those contributions, on purpose. So that's why really a tax plan, as we say, on both sides, on the accumulation side, what percentage should go in Roth versus traditional? And then on the distribution side, the same question, what percentage is coming from the taxable portion and what's coming out of the tax-free portion, and how all of that blends together, Tony, over the course of a retirement plan, through passing those assets on to the heirs of this money. Tony, it can be hundreds and hundreds of thousands of dollars that are being saved because of the efficiencies of the strategy.
Yeah, exactly. I think that's huge. And you can save a lot. It can make or break your retirement, in fact. And, again, you have to keep in mind that with the traditional 401k and IRA, that's somebody thinks, oh, I've got $100,000 in my 401k. No, you don't. You got 20 to 30% is Uncle Sam. That's a joint account with Uncle Sam. And, I don't even think he's my real uncle, Anthony. That's the problem with him. Uncle Sam and Aunt Irma will get you when it comes to taxes in retirement.
Boy, right? Irma's funny too. Yeah, I was with some clients the other day, and we were talking about Medicare, and we're talking about IRMAA, and I'm talking to the fella, and we're talking about IRMAA, and the wife, she looks at him and says, "Who's IRMAA?" You know,
Right. Oh, that's Aunt Irma. That's the
Yeah.
mean aunt. That's not one of the nice, the friendly aunts. That's your mean aunt, Aunt Irma,
Yeah.
because Irma will come and raise that $202 is the current
Oh, it
the
can go up.
premium, Medicare premium. It can go all the way up to $600-700.
Yeah. Well, IRMAA, for our listening audience that don't know who IRMAA is, IRMAA stands for Income Related Medicare Adjustment. And so depending on the income in retirement and when you get on Medicare, your Medicare premiums for Medicare Part B, as Tony mentioned, can be as little as $202 a month, but it can go up to $600 a month, depending on how you're structuring income and what your overall income is.
Yeah, and they look at your adjusted gross income, and they have a formula to use.
Right.
So you want to keep that taxable income down in retirement, and
Under the
that's why
wire.
we're talking about tax strategies today,
Yeah.
and somebody who can put that together as part of the plan. And you talked about needing to see that big picture, Anthony.
It
So
is.
before we go today, let's talk a little bit more about that. To get that big picture, that's what you do. We're at home, our listeners, our viewers, you're sitting there with your finances, your investments, your retirement plan, and the pieces of that puzzle are laid out all over the card table, right? You got set up to put together your puzzle. You're looking at 1,000-piece puzzle, but you have no idea what it's supposed to look like. You're too close to it, right? You're just seeing these pieces. Well, the box lid, that's why you need to work with a financial professional like yourself, Anthony, because Anthony, you've got the big picture. You can help them see the big picture, the most important piece of any puzzle, not the last piece, not the corner piece. It's the box lid, because that has the big picture on it. And you're not going to get that puzzle together without, if you didn't have the box lid with the picture on it, you'd be stuck, right? So that's where you come in. And how can our listeners out there, Anthony, get a hold of you to set up a no charge, no obligation consultation, or get a copy of this 2026 taxation guide?
Absolutely. So, two ways. One is just pick up the phone and call us at 504-828-2171, or visit us online at crescentcityretirement.com. We have all the past shows. We'll have this show up loaded there on our website. And we have a little button there to schedule a 15-minute retirement readiness call, or you can just simply request the tax document that we're talking about, Tony and I are talking about here. And let me just say, when we think about a retirement plan, there's really 5 key pieces that are involved in a retirement plan: estate and legacy planning, healthcare planning, investments, and income. And let me say that last piece is taxes. And I just want to say, Tony, taxes infiltrate all aspects of the retirement plan. It gets involved in your estate and legacy. It gets involved in your investing. It gets involved in your income, and it gets involved in your health care. So taxes really is an overlay of all pieces of the retirement plan. So it needs to be tax efficient. We don't want to, do a good job in one area and then a really poor job in another area. We really need to be efficient across the board for the retirement, the plan to be all it can be. And that's really our objective here at Crescent City Retirement Group, is to help our clients develop a very efficient strategy, a tax efficient strategy, and really keep more of their hard-earned assets to enjoy for themselves, and ultimately to pass on to their heirs. Can't hear you, Tony.
So, Anthony, that sounds great. I think this has been a great show. But one more time before we go, let our listeners know how they can set up that no charge, no obligation consultation, or get a copy of that 2026 taxation guide.
Please just pick up the phone. Call us at 504-828-2171, or visit us online at crescentcityretirement.com.
All right. Great show today, Anthony. Listeners and viewers, thanks for tuning in. That does it for today's episode of Wealth Builders with our host, Anthony Cangemi.